Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bakra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwynn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. Hi everyone, welcome back to another Bondcast. It's been a week with fairly big market moves, so particularly on some days led by the US. So Blake, can you just give us a quick update on what you're thinking here?
Yeah, Tuesday was actually, a pretty astounding day. You said amazing. We were out on Monday. We saw global markets sell off. So there was obviously some catch up to do, I think, when US markets came back in on Tuesday, but we far surpassed I think any kind of sympathy with other markets. Given the sell-off that we saw in 10s and 30s, it was pretty focused at the long end. We were in probably one of the top sell-off days in the last 3 or 4 months, and it's kind of interesting because the other days that saw really big moves like that, you can kind of name because of the events that coincided with them. It was the day of that the election was called for Biden and that we got Pfizer news. It was the day after the Georgia elections. Yesterday, we really didn't have anything going on. There were no big catalysts. There wasn't any kind of clear blaring sell signal going on. It's just markets came in and started off on the back foot and really took it from there. It's also worth saying that this was entirely a race phenomenon. I mean, equities were essentially flat. We saw a little bit of dollar move, nothing really that big. It was purely in the rate space. So in the end, I think, rather than kind of one big event, like some of those other big moves we've had over the last 3 or 4 months, this was really just a combination of a lot of little things adding up. I think we had some continuation of the reflation trade, even though it's worth noting that yesterday, really wasn't in the break-even space. It was more of a real yield move, but still, I think that kind of big reflation theme that's been going on for several months now was continuing into yesterday. Obviously we had 10s and 30s supply last week and we have 20s this week. So I think long end supply was probably weighing. And also there's kind of a technical piece to it. We came in and very quickly moved past 2 levels, rate levels that I think a lot of investors were looking at in 10s and 30s, 122% in 30s. So once we kind of went through those levels, I think there was a little bit of space for markets to run on the technical side as well. So all those things kind of combined and gave us a very big rate move on Tuesday. And it looks like, at least on Wednesday when we're recording this, it is continuing. So we'll see how that shapes up for the rest of the week.
Okay, thanks, Blake. So Giles, we've had, fairly big moves also in Europe, although they haven't been leading the way, I guess, in the same way that the US and the UK have in the core rate space. The other big move that we've had in Europe is in BTP Bund spreads, where investors have taken a lot of comfort, I guess, in a Draghi-led government. And once this podcast comes out, we will have published our updated forecast for BTP Bunds as well. So can you just talk us through our latest thoughts there?
Yeah, well, actually, I don't want to not mention the move in euro core rates, to be honest with you, which I think, although it didn't match basis point for basis point what we saw in the US. I mean, it's given the low volatility that we've had over the last several months, it was still pretty remarkable. And I think that there are questions about how to interpret this in addition to the international angle. I mean, there's been a lot of supply, and that was a little bit of a shock perhaps over the last couple of months compared to the end of last year. We've been discussing things like gamma hedging, which I mean, technical types of thoughts, but can at times lead to these kinds of outsized moves. And we've also been talking quite a bit about the level of belief that investors seem to have in a continuation of this move. And overall, I just echo what we've just heard from Blake about the significance sometimes of shifting through psychological levels and technicals and so on. And one thing that we've been talking about a lot is this idea of breakout. And I mean, we don't deal in technical analysis particularly, but it is quite remarkable what's happened on certain charts. But at the same time, we're not getting from investors that there is a lot of desire to particularly chase this particularly aggressively. This idea that low inflation is really the long-term theme and will just sort of naturally revert towards that is pretty persistent. On Italy, I mean, as we've said in the last couple of weeks, we're still pretty positive, and even at these long-term tight levels in BTP spreads, we think that compared to the whole sort of set of circumstances that we've seen at any point really over the last sort of 5 or 6 years since QE began, really, we haven't really had quite such a positive mix. And remember that one of the things that we've seen over this whole period is foreigners have been fairly significant net sellers over the long haul in BTPs, and this is the kind of change that could actually bring them back in. So we're still positive.
Great, thanks, Giles. Now, Theo, you've also had a big forecast change this week. You've upped your gilt yield forecast quite significantly, and actually the moves that we've seen in the market over the past week or so mean that we're actually not that far away from your new target. So can you just give us a quick rundown on what's driving that kind of change in view from you?
Yeah, thanks, Imogen. I think it's well, as Blake and Giles have mentioned, the market is moving. I think for us, we need to make a clear difference between 2020 or even 2019, 2020, and now. We've been consistently bullish in the market. We had a 0.2% forecast for 10-year yields throughout 2020, and we've moved it to 0.75. So this is a clear shift simply because the reasons to hold gilts have changed. So if you think about it, you had politics that could provide support to the gilt market and could provide a gap risk where the market just rallies simply because of fears. That's one. The other thing was about the Bank of England potentially delivering lower rates, and that has changed at the February meeting. So this is one reason. The other reason is really how that plays with economics. Obviously, the economic backdrop is getting better, and we talk about the vaccine rollout, and the theme is about the reopening of the economy. So this means that rates need to adjust for that. And there are two more reasons that are relevant to that whole story, I would say. One is really QE and potential changes, or the buying, of bonds, asset purchase, or the potential change, a slowdown in the purchase of those bonds. That's one. And that's obviously that will weigh on the market and will make gilts cheapen. And the other reason is really supply. And we think that supply going forward will shift to the longer end of the curve. And once that happens, you have more duration coming in the market, and that weighs on gilts. So yes, this is a significant, high conviction shift in terms of view, and we are bearish gilts. And as things stand as of today, the market has moved by 15 basis points since we put out the forecast, and there are 15 basis points more to go.
Okay, what do you see as the biggest risks to those views then?
I think the one question that I have received, and I think it is quite key, is I'm thinking in a UK context, and what can the UK market do? But this is, the UK is not just living in a vacuum, it's not living in isolation. And I think that one possible risk is that fixed income in general weakens. So if the continuation, and if we get an externally driven sell-off, that then we don't talk just about a 15 basis point sell-off in gilts. We talk about a 30 or a 40 basis point sell-off, which again will be very, very significant. So external, other markets, the euro, the US market, they could induce a deeper sell-off than what we forecast. And the other risk, which is at the opposite side, is if we do see an early shift in BOE narrative and language. As things stand, the BOE seems to be okay with a move higher in yields. But if we see a change in language, then this actually could be a big argument for yields to go the other way around up. So that could be a potential risk to the opposite side.
Okay, so I would say the big theme of this week, really, as we've heard mentioned by Giles and Blake, and we're going to do a bit of a deeper dive on that all together in a minute. But I guess just while in the context of your forecasts, how much does inflation matter then?
Yeah, inflation is a key component, because when we talk about central bank policy and when we look at the forecast horizon, at the 2 to 3 year forecast horizon in the UK, obviously higher inflation numbers create a bearish bias. So as things stand, we don't think that it will be an inflation story. I don't think that we will have really an acute inflation problem in the UK. But I think that what the market will have to look at is growth and the labor market, and to what extent the scarring is indeed so lasting, is so deep, is so damaging. And I think that this is where you could get the upside surprise. I mean, right now, clearly, inflation expectations are still high. We think that it will be difficult to exceed those high inflation expectations in the UK. In fact, today we had an inflation number that came weaker. So we think that inflation per se will not necessarily drive the market this time, even though it is usually mentioned as an important driver of the fixed income market.
Okay, thanks, Theo. So I guess just digging a little bit deeper on that inflation theme then from a kind of global perspective, Blake, you talked about the sell-off over the past week or so not having a single obvious driver as those bigger days moves have in the past. But one big theme has been this shift from markets being fairly pessimistic to fairly optimistic about inflation now rising again. I guess there's a few different drivers of that. Giles, can you just kind of talk us through what those different drivers are and how they've changed market-based inflation expectations?
Yeah, sure. I mean, this is something that we've been talking about for several months now. And I mean, one of the things that I was trying to make the case for towards the end of last year is that the crisis might well be remembered as a sort of punctuation point between the very deflationary decade and something that looks quite different over the next 10 years. But obviously, the debate has shifted pretty quickly. No, I mean, I would say in the short term, the things that people are latching on to as potential triggers, obviously there's more focus on fiscal policy, particularly in the US, and I'll leave that to Blake to discuss, but there's been a particularly interesting sort of debate in the sort of high echelons of opinion formers in global economics about, I guess, the potential discrepancy between size of stimulus and the size of output gaps, particularly towards the end of this year, which certainly point towards potentially higher inflation pressures building. We've got, in addition to that, obviously more confidence in the COVID recovery, which is something that we have been trying to remind people again and again and again. We should have more confidence in, and I think that has been building with relatively successful initial stages of vaccine rollout in particular in the UK and to a slightly lesser extent, but still pretty good in the US. So I think it's just that there's a bit of a cyclical story. On the tradable side, global trade has been super strong. Commodities prices are picking up pretty quickly too. I don't think that people really know what to say about services in general, but I think that there will prove to be quite a lot of pent-up demand to come out over the coming couple of quarters, 2 or 3 quarters. And we may well see that the firms that are there to service that demand are actually a little bit on the cautious side. So I'm just going to leave that there. I think that there's a pretty heady mix potentially for inflation. And although we're not talking about a dramatic rise in inflation to way above target or anything like that in the short term. I mean, certainly, I'm one of the more optimistic members of our group on a reflation, and I certainly don't have that kind of scenario in mind. But I do think that the skew of risks that many investors had in mind, particularly in Europe, was far too much to the downside. And I think that there's a shift of emphasis going on at the minute.
Okay, so what about in the US, Blake? I mean, markets are pricing inflation quite high, but it's still not at the peak. We've certainly seen higher levels.
Yeah, it's kind of interesting because, listening to Giles there, like I don't actually disagree with him that much in kind of the shorter run that this kind of COVID recovery story that we're going to get out of the other side of this, probably in the second half sometime. And, vaccines and everything are going to allow us to get back to some semblance of normal. We're going to see a boost in services and kind of pent up demand that's going to give us a temporary boost in inflation. And I think that's a very, very consensus story. I mean, I honestly don't think I've talked to an investor in the last 3 months that hasn't generally agreed with that point. You see it in the price action, you see it what's going on in markets. I think what's more perplexing to me, or the part that I disagree with more, is more the structural side and kind of what happens after a year or two. And have we really changed kind of the nature of either the central bank's response function or something about the nature of inflation? Is there something that's shifted, that really kind of changes that forward-looking measure of inflation? Because it's not just that break evens have gone up in the US. I mean, we've also seen forward measures of inflation, 5 years at 240, 250, somewhere in that range. So, and that's been a steady march up. And so that's the part that kind of intrigues me, and what's really driving that. And I question sometimes why we should think that we're going to be in this kind of different regime after all of that kind of boost, that temporary boost in services and people getting back outside after the pandemic. After that kind of wears off, what leaves us higher? I mean, we have had the Feds change their framework to this flexible average inflation targeting, which essentially just means that they're going to presumably allow inflation to run hot in the future, more so than in the past. But to that point, I borrow a line from one of our colleagues, Brian Dangerfield, who when that policy was announced said, just because his favorite football team, the Giants, say they're now going to try to win 2 Super Bowls in a row instead of 1, okay, great, that's fine. They can't even win the first one. So I felt kind of the same way about the Fed. I mean, they've been, through all the easy policies of the last, of the post-financial crisis period, haven't really been able to generate, meaningfully higher inflation. I mean, there's something structurally going on. And, I think moving to this flexible average inflation targeting, yes, on the margin, it does mean we have higher inflation. The Fed's going to allow higher inflation longer run, but will that actually come? And that's where I have some doubts. I think a lot of the recent boost and the more kind of recent leg to this reflation story has really come on the U.S. fiscal story, as Giles mentioned. Most of the moves we've seen followed, Biden being kind of proclaimed the winner of the presidential election, and then that got another second leg after the outcome of the Georgia elections, when it became clear that Democrats were going to have a trifecta in government. They were going to be able to kind of push through some of these fiscal policies that I think in the interim between the Biden victory and these Georgia elections, everybody was a little unsure, including me. I was very pessimistic on Biden's ability to get anything fiscal done if Republicans still had control of the Senate. So that Georgia election really, I think, gave this whole thing a boost. Everybody started kind of pricing in, higher fiscal expectations. But again, I'm left wondering what's really driving the last leg of this move in the last 2 or 3 weeks, when all of that, all of the fiscal package has essentially been priced in at this point. So what's continuing to push us higher and higher? And I think that's a question I'd still like answered.
So a question I'd like answered then off the back of that is where does this leave you really with your treasury view then? If you think that nothing, I guess, has changed in terms of the long-term view, does that mean that treasuries are now in the right place? We've reached the kind of highs of recent ranges, as you said at the beginning, or do you still see further to go in nominal rates?
Well, it's funny because what I was just saying sounded very pessimistic, but I still find it very hard to get long treasuries here, or to get out of steepeners and in turn start looking at flatteners. Yes, steepener positioning is crowded. Yes, I think some of this stuff is overdone. But as we said, I still do believe that we have some kind of second half bump. And so it's really, there's kind of a timing issue here in that, yes, I see higher yields by the end of the year. I see steeper curves by the end of the year, but I do think in the interim, in the next 2 or 3 months, it's going to be, I think at some point there's going to be a little bit of a struggle to continue this momentum unless we get some other fundamental catalyst really develop. Whether that's the passage of the first stimulus package, and then the Biden administration immediately starts talking about a big infrastructure bill, that would give us a boost. I think we're going to need something like that to really give us, to keep the wind in the sails of this trade in the near term. So I guess my point is, if I see yields higher at the end of the year, and I still think there's kind of these near term risks that we get a quick passage of stimulus and start talking about infrastructure. I think the Fed's essentially on the back seat for the next few months. I don't think they're going to come out and do anything that's really going to push yields lower. So it's very hard to kind of fight against this move. And I think the right position at this point is basically to stay with it as long as the music's still playing, even though, I have some uncertainties and questions about what's really driving this whole reflation trade.
Okay, thanks. And I guess, well, not really surprising given what we heard from you earlier, Giles, with regard to your view on this kind of reflation theme. But we've been saying for a few weeks now that, nominal rates in Europe is really where the best opportunities lie, because that's the market that has so far not played catch up, if you like, to the shift in market-based inflation expectations. Do you still think the same? I know I've kind of already answered that question for you, but if you could just give us a kind of more detailed answer might be good.
Yeah, one of the things that I've repeated again and again and again and again in conversations with investors this year is that I just think that the European fixed income has become so conditioned by this idea that we're in this long-term kind of low inflation type liquidity trap. I suppose after years, there's even probably been selection bias. Whereas if you didn't believe that, you probably haven't been very successful. And I do think that we are, we're talking about nothing really less than a paradigm shift here. I'm not going to go into this in any detail, but no, I was just noting down a few sort of longer term factors that I think actually go some way to answering Blake's questions about what keeps this inflation sort of higher inflation theme going beyond this year or perhaps the beginning of next year, once this fiscal boost kind of sugar rush maybe dies away, and I can see globalization kind of going into reverse, supply chains shortening. I can see expenditures on green investments with very, very long term payoffs. I think that migration is probably past its peak. I think aging is probably more inflationary than people realize. I think that digitalization probably, especially compared to the years just after the financial crisis, I think that revolution is more likely to give way now to regulation of big tech, and that's more likely to be inflationary as well. So I can see lots and lots of reasons why this could continue to go, but that's another podcast perhaps.
Sounds like a very in-depth podcast on that alone. So Theo, just I guess to bring you in on this, because I know that you look from our side on the strategy side at inflation very closely. How do you think investors are really feeling about this? Do you think that everyone thinks that the risks have now shifted towards higher inflation, or is this just a short-term view, or are we really moving away from that kind of very low expectations of inflation, I guess, particularly in Europe?
Yeah, I think this is quite a key question. I think the interesting part is what's going on with the front end of the curve. Not a lot of guys have been positioned for this unusual rebound in inflation expectations. And it's unusual because really this is driven by the very front end of the curve. So as things stand, I think that in the US, it's very much a front-end driven story, a front-end inflation story. Because if you are to see that rebound in inflation, you're more likely than not to see it now rather than much later. So this is, I think, clear. I think this is why if those who look at inflation steepeners, well, they may have a hard time in the US because, well, it's the dynamics on here, and also in terms of investor positioning, I think that the additional flows can still be supportive at the front end of the curve. Now, the other thing that we see is that there is some support for the front end of the UK curve, because the UK did lag in terms of inflation, and this is something that can play supportive. That it has lagged, so it is like the cheap inflation market. But today's print didn't show that inflation does rise at a fast pace to justify expectations. So I think that the UK will continue to be a market that does lag. Well, on euros, actually, it's I will leave it to others to comment. But if something, I would say that for me, among all those markets, the US is really the market where you can see, and we have seen actually the rebound. And this is also why we think that one of our key themes that we played it in 2021 year ahead, which was to be bullish on the front end of the US inflation curve, that this theme still holds.
Great, thank you, Theo. So it sounds like this is a theme that we're going to return to in many weeks to come. So I look forward to continuing this discussion, given we have a lot of differing views on the team, certainly, and I'm sure there's a lot of differing views out there as well about this theme. So I look forward to talking about this more in the future. Thank you, everyone. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.